Good evening, Theo Trade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 6th of February, 2020. With the markets at new all-time highs, at least mainly the S&P, NASDAQ, and other equity futures at or near those all-time highs, I thought it'd be nice to take a look at the broader perspective of money flow, or specifically, where's the money going from the S&P and crude oil, which we think of as risk on or bullish type of assets or markets, and the other side, which is risk off or defensive, and those are gold and treasuries. So where's the money flowing? What's happening? Where's the trend? And where are the opportunities? Even if you don't trade the other markets like gold and bonds or even crude oil, it's good to take a look at where the money's flowing and whether there's risk on, risk off, and what does that mean for your short-term and intraday trades? So we can see that on the hourly charts, just a comparison, that the S&P, and we could even throw in the NASDAQ as well. We'll link these. Take a look at the NASDAQ, that those continue to trade higher highs, higher lows, with a minimal pullback at the end of January. So back to the S&P, just for comparison, we do have these uptrends. You can't maybe see that now, but let's pull the perspective on these markets back a little bit to the 4-hour chart, and you can see that. So the 4-hour chart just kind of takes it inside. It really takes two of those daily bars or daily candles. So the broader picture is up. Now, that's the market with which we're dealing, bull market uptrend, and there's some other type of action taking place behind the scenes, and that's what we'll focus on tonight. For example, crude oil and equities or stocks tend to trend or move or trade together. Or, in other words, it's a positive correlation. That's the case most of the time. But you can see how crude went a little bit lower, trading down according to our game plan from the 63, 62 per barrel level. We'll look at all these charts in the daily chart in a moment for positioning, but that's the main idea, that crude traded down away from resistance all the way to 54.50, a target. And once that level failed, all the way down to 52 and a little bit under 50. So crude has a little bullish buy opportunity in that. But the stock market got a little stronger. Both markets fell through the end of the year, or into the month in January. And in February, well, stocks rallied hard, but crude did not. So it's a little bit of a divergence there. So that's a little separation in what we call bullish or risk on money flow. Back to that in a moment. The other way is gold and treasuries. We've been discussing this, Don and myself, on the bigger picture with respect to the bond market, which is this, and gold surging, trading to the upside. We can see how that played out on the daily chart because that was a couple of swing trades, or one or two swing trades, where both crude or both gold at the top and bonds at the lower panel had a buy signal. So that has taken place. We've achieved those upside targets. I kept mentioning the concept of in bonds with the uptrend and the bullish breakout that happened a little bit after. So the gold went first, bonds went second in terms of rallying up to those new highs. While we're at it, let's pull that perspective all the way back to the daily chart just to compare. So these trends were similar, right? April on the comparison start. There's a little bit of similarity, right? The chop, 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 or the overlap zone, the breakout bullish, but then that's where crude went the other way from our resistance points down to our support, and stocks went higher. And the other markets, which were defensive names or risk off, protective markets, you'll see money flow there when they expect the equity market to fall, or at least where they want to be defensive. Gold broke as expected to the upside, to the higher levels. And later, once again, really about a week or so later, so did bonds. So now let's take these markets individually. That's a broader perspective, by the way, and how the money has been flowing and how there's a little bit of a disconnect. So back to the S&P, there's our new all-time high. And I would be not doing my job if I didn't scan a little bit with you here on those stocks, 60 of them, making new 52-week highs, and some of which are making new all-time highs. So from market cap, Johnson & Johnson, Procter & Gamble, Home Depot, Pepsi, Eli Lilly, and IBM, little trend day today after some earnings, UTX, Lockheed Martin, and General Electric, just to name a few of those large market cap names. But again, 60 of the S&P 500 stocks made new, in some cases, all-time highs, or otherwise new 52-week highs. That's strong. Key is whether we turn away from this level or keep going. So I'd say we're at a similar point in terms of the future planning to where we were going into December, with the market retesting out the high. It broke to the upside, and the other pullback, tiny as it were, into January, which also led to a break of new highs. So that's where we are. Pullback, retracement, flag, and up to new highs. NASDAQ is stronger, but that's the equity market. Now let's turn back again to crude. I like to look at these sequentially. So we had a sell swing call out trade from the 62 level, 63, and all the way went to 64, down to 54, and then all the way to 50. So we would call crude oil as a trading market or a structure market as filling out this range. So we had short sell trades up here. We have long buy trades recommended down here. In out spreads, bull verticals, or different type of call positions or long positions in either crude, CL, or USO or other related funds or stocks. That would include ExxonMobil, just for a reference there in terms of stocks. And that was a rough sell-off there. Remember, stocks will not directly correlate to crude oil, but if you don't trade the futures, that's another proxy for you. Outside of crude, and there's your hourly chart, gold on the risk off market had its bullish break, bullish upside potential, and the bullish call out here, and a second little bull flag. So we're consolidating, chopping, getting a range filling out on gold, but mainly it would be considered to be bearish or short-term defensive or bear positions. Take your profits if long. If you're aggressive, look to get short into this 1600 per ounce level. Finally, bonds, we'll look at ZN first. Achieved or fell just a tick or two shy of the prior swing high. The most recent call out or optionable trade type of strategy was a long bull breakout support or a long bull breakout of the flag. And being back to 131, that is your target. So traders here and elsewhere are taking profits into that prior high. If you're aggressive, you have a couple of short sell trades. And the TLT, which is your tradable ETF, same type of logic, and your pivot was 145 per share of that ETF there. So now, as we go forward, these are where the markets have been, where the most recent trades have been, and the future, right? Hindsight is 2020, but we got to plan these next set of trades. So given that we are into a type of support level for the bond market, watch into this next week, Friday and next week, 142 per share on the ZN. That's going to be roughly the 130 futures level. And for the 30-year bond, that's about 160. For the S&P, now keep in mind, we're looking for a possible bullish short-term bounce off of those support in bonds. And if that would be true, the equity market could fall. But, right? We don't make plans for the future. We make plans, yes. We don't make predictions about the future, not as traders. If these bond market levels fail and the bond prices go all the way back to the breakout spot, that would be to the breakout levels there. That's a catalyst for seeing the market go even higher. Can it do it? Oh, yes, it can. Any example for that? Oh, sure. Into October, November, and after the little turkey, the Thanksgiving Day pullback, or Thanksgiving week pullback, into December. So don't make the mistake of thinking the market has to stop and turn and go the other way at the prior high. It certainly does not. Plenty of examples of the market hitting resistance and jumping right through it. And that's in part on the backs of short sellers or funds or hedge funds or quant funds or whatnot that are defensive or overly protective. And when they cover their shorts or cover their positions or roll back into the bull side, which we call that money, the risk on money flow, well, that's a catalyst for higher equity prices as the bull market continues. But again, the levels for next week will be this 3335 and ultimately where we closed. Always be careful, safe, and keep those positions on, the hedges on, and be protective. This is Corey Rosenblum with your Theo Notley video for the 6th of February, 2020.